Allison, who's former BB&T CEO. He's also president of Cato. Welcome. Gentlemen, welcome to both of you. We have a lot to discuss with you, but first we want to get to some of the things we're going to be talking about over the next 2 hours. Guys, we have you here because we have some serious issues, things that are facing our nation, and I know you both have some very serious thoughts about them. Sure. Senator, you brought some cups that I think lay out some of your concerns.
Well, listen, what I'd like to talk about, obviously, is how do you start decreasing the level of uncertainty, brings you back to this economy, restore confidence so we can get our economy growing again, which is the primary, that's the best way to solving our fiscal situation. But I think the other problem we've got to solve is the fact that people really don't understand the depth of the problem. So you're aware I'm big into charts and graphs, and we put some of those on cups, things like the bankrupting of our Social Security system. So it really is about getting the American people to understand the full depth of our situation so we can actually make the tough choices.
We've had a lot of people who have talked to us who have said that this is not something that Washington would be able to handle on its own, that it's not something they expect to get passed unless the American people kind of step up and push for this. I guess that's your opinion at this point?
Absolutely. The American people need to understand what the problem is so they actually support the solutions, which aren't going to be real fun, quite honestly.
Okay. And, John, same situation that you're concerned about this?
But the thing I would hope we could focus on is the fact that the real challenge is government spending. How our spending is financed is less important than the fact we're spending too much. Government expenditures, including the regulatory costs, which is really a government cost now, are over 50% of our gross domestic product. A country that operates that level ends up with much slower growth rates. And the compound effect of that is to radically reduce the quality of our life in 15 or 20 years. And that's something this economic history is proven. Friedman proved this a long time ago. So the challenge is how can we reduce government spending, which is really out of control.
So you're president of the Cato Institute.
Not yes, the Cato Welcome, right.
Yeah, yeah.
Yes.
Because they squeezed in. I don't know why they put, well, yeah, okay. So when did you take over, John?
I took over October the 1st.
No kidding. The whole deal, Cato. And now, John, man. So, yeah, they're breathing more objectivism into an entity that's already got a little bit of objectivism in it already, doesn't it?
Absolutely.
Enlightened self-interest and
rational self-interest and limited government.
And limited government.
The history of limited government is good, and the history of big government is bad.
Well, we'll talk in 2 seconds because I just made a point with Kevin offhand about, everybody says Washington's broken, and it's like, there are people sent to Washington that are trying to stop a freight train headed in what they feel is the wrong direction. And if that means, I don't know whether Washington's broken or Washington is in the gridlock is the last thing we've got going for us to try to keep us from ending up where we don't want to be. So.
The governing body of government reflects really how broken government is, quite honestly. So I don't know why anybody would expect. I don't know too many people who think government's particularly effective or efficient. I don't know why they think the governing
so
body
by definition, government stuff. And when you got a country that is this divided about which way we want to proceed, when we've got these entitlements that right. People love entitlements, but we've way overpromised. And there are people that don't want to give up any of them, and there's people that realize we're not going to have any entitlements if we don't reform them.
That's absolutely true.
All right, well, we're going to dig into this a little deeper because we have both these gentlemen with us for the next 2 hours. In the meantime, though, we're talking more about that recent Wall Street rally. It's hit a little bit of a speed bump over the last few sessions, and joining us right now on the Squawk Newsline is Mark Faber. He is
2010, the Tea Party got swept in on the biggest gains that we've seen in years and years and years. There was a totally different feel. By the time 2012, John, came around, we're back to Obamacare is going to be the law of the land. Entitlements are growing, and we know, Obamacare. Not only is Medicare already a huge entitlement, Obamacare just doubled down on all of our entitlements. People voted for it. People voted for government. You're running the Cato Institute right now. What's 2014 going to look like, and what can Cato Institute do to try to, I don't know, orchestrate some type of a comeback for your side?
Well, we're working on that very hard. And the idea we have to do is to convince people that the consequences of these policies are incredibly destructive, particularly for their children and grandchildren.
Totally fell on deaf ears this past election.
Well, but we have to keep fighting that fight. And unfortunately, it's going to be a hard message to get through because I don't think we're going to fall off a cliff.
I would love, look, if you, let's say last night, maybe I wanted Notre Dame to win because of, for whatever reasons, just maybe I shouldn't have because maybe it wasn't very realistic. But if I could should take the side of the team saying, we're going to nail 10% of the people and we're going to promise a bunch of stuff to the other 90%. I would go with the 90%. I think they can get more. I think it's easier to get 51% out of the 90 than it is to get 51% out of the 10. And I would short your efforts right now, John.
Well, I think it is. I think it's a real struggle, but I don't think it's one we can give up on because it's the future of Western civilization. The policies we're implementing today don't work. They've been proven to fail in history. Countries have fallen over and over again for this time.
Periods like this before, John, where I mean, there are inflections, but we've never had this many people on the receiving end of government in the United States.
Not in the United States. We haven't seen this period. But I do think that the Republicans need a real message that's a more libertarian message, because it's hard to know whether Obama won over economics or whether he won over social policy.
Everybody gets to use their own.
There's a lot of.
I understand.
Although,
I believe
we have Simpson and Bowles, Alan Simpson and Erskine Bowles, bipartisan group. They have been trying like mad to get people to pay attention to this message. They're out again today. They're going to have another time out there. And the fiscal message, even a bipartisan fiscal message, doesn't seem to be picking up steam, even though they have been out there working their tails off to get the attention brought to them.
No, I think it's a hard fight, but I don't see how we can help but fight that fight. And I particularly think, and my efforts have always been directed at college students who have a huge vest in this and are open to new ideas. And what you see in college is more and more. Now, they're still a minority, and even though the majority of them vote for somebody like Obama, they vote a lot over social issues. But they're starting to understand the long-term consequences and are open to, I believe, the libertarian ideas versus traditional conservative ideas.
You should feel like McGovern did at the end of the second Reagan term. You should feel about it that the liberal ideas and ideals were about as popular right then as conservative ideas right now.
Well, and part of the problem is we just ran an election. About $7 billion was spent. And what information did we get out there other than President Obama misled the American people thinking, basically saying that 2% can carry the burden. They can solve the problem. Just a balanced approach, and it's not going to solve the problem.
Okay, we're going to continue this conversation coming up. He would tell you the world's about to implode.
I think there are very serious global economic problems. Unfortunately, I think what's driving the stock market is what the Fed does. If it keeps printing money, it's got to go somewhere.
Right.
And until we have some really bigger negative consequences or a dramatic thing around this, the debt thing, the market will probably keep going up, although it should in a certain long-term economic sense. But I think the market's driven by traders right now. And traders say, well, if the Fed keeps printing money, it's going somewhere. And stock is one place it will probably go for a while.
Yeah. And for people who are looking towards retirement accounts, they're just saving and trying to save some money up. I know, Senator, you've been looking at where that money would have gone if it wasn't going into Social Security. You'd get much better returns.
Well, I'm an accountant, so I do spreadsheets. So I do the spreadsheet and just made the assumption if you took the payroll tax that an individual that's retiring today, they'd put that into just an index fund of the Dow Jones, not even counting the dividends, and they paid the maximum payroll tax amount, they'd have an asset worth $1.2 million versus the net present value of their expected Social Security benefits, about $255,000 if you discount it 7% now. It hasn't been a very good deal.
We get people who write in and say that, look, the Social Security, you can talk about cutting benefits, but this is my money. I put in for it and I want it back. How much do you put in versus how much you get back?
First of all, for Social Security, they're not getting a very good deal. They are correct with Social Security. It's Medicare that they're getting a really good deal. They're putting in a little over $100,000 and their expected return is about $350,000. I mean, last year, we spent about $1.25 trillion on Social Security and Medicare, but the payroll tax only brought in about $850 billion. So we basically paid out.
Because of the cuts to Social Security? I mean, the cuts to the payroll tax.
That was about $100 billion of that. But still, we underfunded those programs by about $400 billion. So in other words, we paid out 50% more than we brought in. These programs are unsustainable. And that's really what we have to start addressing is how do we reform those entitlement programs that so they're available for future generations. And that's what this president must lead on, and he hasn't provided any leadership to date.
Thank you for being here.
Pleasure.
Appreciate it.
Thanks.
But what do you say from the shareholders' perspective?
I don't think they will do it, even though I think there are some fiduciary obligations. We were talking about this earlier. I do not think that AIG needed to be bailed out by the U.S. government. They could have easily gone into a normal bankruptcy reorganization procedure. It would not have taken out the insurance market because their subsidiaries weren't in bad shape. And
shareholders would have gotten wiped out in that situation.
Who?
Shareholders would have been wiped out in that situation.
Possibly, or some of them could have ended up in some kind of subordinated debt issue, which comes out of some of these. Depends on how bad the shape they were in. You really can't answer that question now.
But the company at the time took the bailout, though.
Shareholders were worked out.
And the knock-on effects to all of the other banks that were being protected by AIG would have been potentially exposed.
I think it would have hurt some of those organizations, but I don't think it would have caused any of them to fail. I mean, Goldman Sachs is a classic one. Why would the U.S. government want to bail out Goldman Sachs?
Look, I think Goldman actually might have been one of the few that would be fine, but I think when you start thinking about some of the European banks that were definitely on the hook and others, and then the knock-on effects and domino effects of that, it becomes a little bit more questionable.
Why would the U.S. government want to bail out European banks? I mean, that's not exactly...
Because the European banks are on the other side. We're on the other side of the European banks. It means it's a global system.
I do not believe that would happen. I do not.
Too big to fail.
Too big to fail.
I was involved in doing all this stuff, and the capital markets were working.
Capital markets were working in September of 2008?
They were working until we announced the TARP program. And that's what closed the capital markets, because people then, they created a lot of...
We're going to disagree on this because I think the facts are different. I think the capital markets, everyone who was at this table, I think they fell apart in the fall of 2006.
Some of the stories we heard behind the scenes were incredibly frightening at that time.
Well, it was if you were a high-risk institution. If you were a healthy institution, we were getting buried with cash. It was a huge transfer of wealth to healthy, well-run companies. It was a natural correction that happens in the market. We would have gone deeper, and we'd be radically better off today if we'd let them. There
were major companies that could have had issues meeting payroll because of the freeze-up of some of these markets, too, though.
Could have been, but I don't think so. I mean, cash, you got to remember, this was not, cash was coming out, the Fed was printing cash like crazy through making loans to financial institutions. A lot of what they did was unnecessary, and it was also a process that created a panic. I went through 1980, I went through 1990. We didn't have the panic.
Ed Keon sitting next to us, too, and we're going to talk to you in just a minute about the markets.
We didn't have to have that panic.
But what do you think about this, Ed?
There was a complete panic in the markets. The bond market was completely frozen. No trading was taking place. None of us like what the government had to do, but I would argue that if we hadn't stepped in, remember that was 1 week after Lehman Brothers that AIG was rescued. Actions needed to be taken to keep the financial markets functioning.
What if you did something with just commercial paper?
Not enough. I mean, the bond market, the entire United States bond market.
What about commercial paper plus FDIC on 250?
I mean, we could talk about incremental things you might have done, but
that's why I say commercial paper would have been money markets.
We were in the midst of a full-blown panic, and it was, in my view, and I think your book shows the facts of what actually happened on the ground. Aggressive action was necessary to prevent the system from collapsing globally.
We created a panic by how we handled it. If we let Bear Stearns fail early on, Lehman would have gone a different direction. Other institutions would have, and if we'd had a plan. It was the randomness of our plan.
I'm not going to disagree with you.
If you change the facts leading up to it, who knows what would have happened.
I won't disagree with you. If you had handled Bear differently, perhaps if you had handled Lehman differently, maybe you wouldn't have gotten to AIG in the same way. But I think given the way the dominoes fell, the options were limited.
Well,
but we're relitigating history at this point.
Because we made an unnecessary crisis.
Having said that, if you were a board member of AIG and you were going to this meeting tomorrow, your answer is that you're not taking this lawsuit.
I mean, I don't think they can. The public relations would be awful.
And what happens if Hank Greenberg actually pursues the case and wins?
Now, then you have to deal with that when it happens.
You're going to be sued.
Yeah, you're going to be sued, and you'll have to deal with that when it happens.
Okay.
Two bad choices to be looking at.
You're right.
All right, let's talk about another story this morning.
Well, BB&T's in the mortgage business, and we've benefited from the same thing. We've had phenomenal volumes. Unfortunately, a lot of it is refinance.
Sure.
and I would definitely agree. The mortgage market has bottomed. The housing market has bottomed, but it's unlikely any time in the immediate future to get back to the level it was, which it shouldn't get back, because people are viewing housing differently, I think. Housing had become an investment, but it's never been an investment. It's actually consumption. Right. And I think most consumers are making more rational decisions and saying, well, I want to consume a house, therefore it should be more affordable.
Although some consumers have also said, look, I'd love to make a more rational decision, but I can't even get credit.
But
it's a lot tougher to get credit, right?
I strongly believe we need to get rid of Freddie Mac and Fannie Mae. I think they were one of the major contributors to the crisis that we had. I'm old enough to have been in the housing market when Freddie Mac and Fannie Mae were bit players. House finance was much more rational. The down payments required were more rational. We had the people that were buying houses were people basically that afford them. The loss rates were very low. Incenting people to overconsume, which is what we did with Freddie Mac and Fannie Mae, ends badly. And that's so you need the government out of the housing market, except maybe with something that's really designed to help low-income people, not something that drives the whole market.
Well, this is obviously a debate that's going to continue. John staying with us. Bill, thank you very much for coming in.
It's my pleasure. Thanks for having me.